Today, we'll take a detailed look at a simple but extremely effective A+ setup for everyday use. As clear examples, I'll be using my recent trades which were posted in my Telegram channel even before they actually played out. In essence, an A+ setup is a statistically justified combination of factors that provides the highest mathematical probability of success for a trade. So how do you find an A+ setup every day? To do this, you need to focus on 4 key conditions that work perfectly together as a single unit. The foundation is always the global context. The direction of entry must be synchronized with the trend of the higher time frame. If the order flow is upward, we only consider long positions, and vice versa. The next aspect is working with liquidity. The entry point is executed at the moment of a sweep of significant levels, because that's when smart money fills the main volume of their orders by triggering the stop losses of less informed traders. Next, the focus shifts to the area of interest. For a reversal to form, the price must test a strong area that has not previously been weakened. For example, a quality order block or breaker that previously led to a structural break. The final factor is the presence of objective magnets for the price. Unfilled inefficiencies and untouched liquidity pools serve as the main drivers for further revaluation of the asset. If you do not have a clear understanding of the targets for the expected move, opening a position loses all meaning. The ideal environment for finding and executing an A+ setup is within ranges, where the market spends about 80% of its time. During these periods, smart money systematically accumulates or distributes its volumes, manipulating liquidity on both sides of the range. And our task as smart money traders is to identify these traces in time and synchronize with the actions of smart money. And the combination of the listed A+ setup factors allows us to do this with exceptional mathematical precision. For our work, we will use a combination of 3 time frames: weekly, 4-hour, and 1-hour. The weekly chart is needed to determine the current order flow. The 4-hour chart is used to open the first trade, while the 1-hour chart is for its confirmation as well as for opening a second independent trade. The analysis always begins with identifying the nearest imbalances. These provide an objective basis for our work as they serve as the most obvious trace of smart money actions. Reaching the bullish imbalance zone triggered a natural reaction, forming a long candle wick. This is direct evidence of aggressive buying. On lower time frames, there will inevitably be a large-scale imbalance in this area, confirming the interest of major capital in further marking up the asset. By itself, this pattern does not yet guarantee the end of the downtrend formed within the current correction, but it does provide a clear signal. With the opening of the new candle, it is most likely that an upward order flow will begin to develop, which we will synchronize with. The nearest magnet for future growth is an as yet unconfirmed inefficiency that needs to be balanced before the asset can be further revalued. Therefore, the key target will be the fulfillment level. As a preliminary macro reference point, the 50% level of the candle's wick is highlighted. This is a conceptual trigger for the subsequent impulsive growth up to the complete closure of the imbalance. Visually, such a movement may seem completely insignificant, but in reality it represents a potential of 30% from the entry point. Having such a plan already accounts for 80% of success. And this is exactly the moment when you need to switch to the 4-hour time frame for its trading implementation. Here it is clearly visible that the support level of the higher time frame does not fully coincide with the actual imbalance zone, to which we give absolute priority. It is precisely this inefficiency that serves as the primary zone for a reaction. It is located below the lower boundary of the range, which creates ideal conditions for reaccumulation of positions by large capital. Smart money will seek to gather all available sell-side liquidity to load up their own long positions, and only after that will the true markup of the asset begin. Let's return to our checklist. The global context and objective were set on the weekly time frame. But the outlined plan for liquidity sweep and testing the zone of interest are the final criteria that complete the classic A+ setup. We enter the trade in the most conservative way possible. We place a limit order at the beginning of the imbalance. This completely eliminates emotions and makes the process systematic and mechanical. The stop loss is placed behind the second candle of the formation, since the size of the standard deviation rarely exceeds 10 to 30% of the range's height. In addition, we always expect a sharp return of the price back into the range. This is the first and most reliable sign of a false breakout, confirming the active involvement of smart money and their intention to push the price upward. The final take profit is set at the fulfillment level from the weekly time frame, but closing the position with a single order is mathematically impractical because the market may realize your scenario by 90% and then reverse, leaving you with nothing. This probability must be accepted as an absolute norm. A systematic approach requires partial profit taking, so we must always determine intermediate targets. The first logical level for taking profit is the upper boundary of the current range. There are no other objective targets on the current chart, so it makes sense to switch to the daily time frame. Here, the level of complete imbalance fill stands out as the first trigger on the path of upward price formation. This is the second take profit. A little higher, we mark the beginning of the next inefficiency. It makes sense to expect its rebalancing due to its proximity to our weekly reference point, which allows us to reasonably expand the potential of the entire trade. The ideal trade structure includes 3 to 4 take profits. No more are needed because that will only spread out your profit and complicate your work over the long run. How should you take profits correctly? In this case, I did it in equal parts of 25% each. This is a balanced method that works great when the initial risk-reward ratio is high. You can consider a more aggressive position holding strategy by distributing the volume in proportions of 15, 25, 30, and 30%, which will provide an even greater overall result. There are no strict universal patterns for taking profits. I always act based on the situation, relying on the specifics of each particular trade. It's important to understand the fundamental purpose of the first take profit to completely secure the position. To achieve this, I try to lock in enough volume to cover any potential loss, even without moving the stop loss to break even. At this stage, you can no longer lose anything and are working solely to increase your final profit. When allocating volume to subsequent targets, I follow a simple rule. If the scenario plays out completely, I should receive at least the minimum systematic result. For example, a plus of 3% to the deposit with an initial risk of 1%. Your locking in of profits must strictly meet the mathematical criteria of your trading system. For clarity, let's look at 2 similar trades but with different approaches to risk. In the first, the stop loss is aggressive. In the second, it's conservative. In both cases, the trader needs to reach the minimum target of a 3% gain to the deposit. In the first trade, we can use a balanced profit-taking pattern, and this will still deliver the desired result. However, if we apply this approach to the second trade, the final profit will be insufficient, less than 3%, which violates the system's rules. To avoid this, in the second case, it is necessary to lock in a larger volume at higher levels, ensuring yourself a minimum of plus 3%. As you can see, competent profit distribution is a situational process, but conceptually simple. The main thing is to clearly understand exactly what result you need to achieve when fully executing your trading scenario. Closing the first take profit gives us plus 0.6% to the deposit. Immediately after this, the stop loss is moved to break even. Thus, right from the start, we guarantee ourselves absolute risk-free conditions and secure the first profit. Now let's see how the trade plays out. The limit order is filled, the price quickly returns to the range, after which aggressive growth begins. A new bullish trading range is formed, which gives us the opportunity to open a second, completely independent trade. Technically, this can be done through a sub-account or on another exchange. You can also use different trading pairs. For example, the first trade is opened on ZEQUSDT and the second on ZEQUSDC. These are the simplest and most convenient ways to manage positions in parallel. The formation of this bullish imbalance serves as direct confirmation of our initial scenario. Smart money has indeed carried out a reaccumulation of long positions and intends to further mark up the asset. The price will naturally gravitate toward the new inefficiency. We expect it to be balanced during a correction, followed by continued growth. Our targets remain the same. There have been no objective factors to change them. With this plan, we move to the hourly time frame to look for an entry point. The golden mean becomes the range where imbalances from different time frames overlap. This is our key area of interest, in front of which a sell-side liquidity pool has already formed. Despite the visual differences from the first trade, the fundamental logic here is absolutely identical. We have a global context, clear targets, work with liquidity, and a zone of interest. This is a classic A+ setup that must be executed. The opening mechanics duplicate the first trade. entry from the start of the POI, stop loss behind the second candle of the formation, and the final take profit at the $283 level. After conducting this analysis, I immediately published the setup in the channel where anyone could open a similar position with a risk-to-reward ratio of 1 to 7.5, which is an excellent result. Now let's evaluate the development of both positions. Perfect execution combined with competent profit-taking brought in a total of more than 9% to the deposit, with a standard risk of 1% per trade. Systematic analysis on just 3 time frames allows you to regularly find such A+ setups. In summary, the search for and execution of a bullish A+ setup always begins with the higher time frame. We identify the current order flow and the targets for future growth. This forms the basic trading plan, which will be implemented on the lower time frames. Here, the focus shifts to the sell-side liquidity pool and the unbalanced inefficiency beneath it. We anticipate a manipulation, which is where the entry will be made. A limit order is always placed at the start of the imbalance. The stop loss is set behind the second candle of the formation, and the final take profit is determined from the higher time frame. Most often, this is the beginning of the opposing bearish imbalance. Intermediate targets are mandatory. They are placed at local liquidity pools and problematic zones. This secures the position and guarantees profit in situations where the direction is chosen correctly, but the final target is not reached. This is what a high-quality and simple bullish A+ setup looks like. The bearish scenario is completely mirrored. On the higher time frame, we identify the downward order flow and operate strictly within its boundaries. An unfilled bullish imbalance acts as the main magnet for the price and the key target for a future short position. On the lower chart, we find a buy-side liquidity pool and the inefficiency above it. This is the standard base for a manipulative move and the subsequent aggressive markdown of the asset. Entry into the short position is executed with a limit order at the start of the imbalance. The stop loss is placed beyond the second candle of the formation, and the take profits are determined by the same principles as in the bullish example. Such formations play out quickly and with a high expected value. This is a classic bearish A+ setup. That's all for now. Subscribe to my Telegram channel where I show real trading every day. There's also an active chat in the channel where you can always discuss any questions with other traders. Good luck.